Pay off your mortgage early or invest. The ultimate financial dilemma. Everyone dreams of financial freedom, owning a home outright, free from the burden of monthly mortgage payments, and watching investments grow into a fortune. But when it comes to deciding whether to pay off your mortgage early or invest your extra cash, the answer isn't as straightforward as it may seem. While the idea of eliminating debt is undeniably appealing, the potential gains from investing could far outweigh the benefits of an early mortgage payoff. To make an informed decision, it's crucial to examine the hard numbers, consider tax implications, evaluate personal risk tolerance, and understand the impact of liquidity. In this financial debate, the choice ultimately comes down to personal circumstances, market conditions, and long-term wealth-building strategies. The numbers tell a compelling story. Consider a homeowner with a $300,000 mortgage at a 6% interest rate. With a standard 30-year term, their monthly payment sits at approximately $1,800, and over 3 decades, they will pay an eye-opening $348,000 in interest alone. Now, imagine they come into an extra $10,000 and decide to put it toward their mortgage principal. This seemingly small act trims 3 years off their loan and saves them $47,600 in interest, essentially a guaranteed 6% return on their money. At first glance, this seems like a no-brainer. However, a deeper look into investing alternatives reveals an even more lucrative option. Historically, the S&P 500 has provided an average annual return of around 10% since 1957. Even if we adopt a more conservative estimate of 8%, investing that same $10,000 and letting it compound for 30 years would yield an impressive $112,619. After capital gains taxes, the final amount still hovers around $97,226, more than double the savings from paying off the mortgage early. These numbers highlight the undeniable power of compound interest and the growth potential of a diversified investment portfolio. Beyond pure returns, tax implications play a pivotal role in shaping the mortgage versus investing debate. For decades, mortgage interest was a highly valuable tax deduction in the United States. However, the 2017 Tax Cuts and Jobs Act dramatically reduced the number of taxpayers who benefit from itemizing their deductions. In cases where homeowners fall into a 25% tax bracket, a 6% mortgage rate effectively drops to a more manageable 4.5% after factoring in tax savings. This diminishes the urgency of paying off a mortgage early, since the true cost of borrowing becomes lower than the stated interest rate. On the other hand, investments within tax-advantaged accounts, such as a 401k or Roth IRA, offer compounding benefits that grow tax-free, further increasing the appeal of choosing investments over early debt repayment. Of course, no financial strategy is without risk, and personal tolerance for uncertainty plays a significant role in this decision. While investing historically provides higher returns, the market is volatile, and downturns can lead to short-term losses. If an investor lacks the discipline to weather bear markets and panics at the first sign of a downturn, paying off a mortgage early may offer a more stable financial path. Mortgage repayment guarantees a return in the form of saved interest, an outcome free from the unpredictability of stock market fluctuations. Thus, an individual's ability to stomach market swings is a crucial consideration when weighing these financial options. Another often overlooked factor is liquidity. A home is an illiquid asset. Once extra cash is locked into mortgage payments, accessing it again becomes difficult. Imagine a homeowner aggressively paying down their mortgage, only to face an unexpected financial emergency. With their wealth tied up in home equity, they might be forced to take out a costly home equity loan or refinance at an unfavorable rate. Investments, on the other hand, offer much greater flexibility. Stocks and bonds can be liquidated quickly, providing access to cash without the need for loan applications or extended approval processes. This liquidity advantage makes investing an attractive option for those who prioritize financial flexibility and quick access to capital. Market conditions also influence the mortgage versus investment debate. As of 2025, mortgage rates have climbed to between 6% and 7%, a significant increase from the historically low 2 to 3% rates many homeowners secured in previous years. This shift makes paying off a mortgage more financially compelling than it was in the past. At the same time, the stock market continues to be a powerhouse for long-term wealth accumulation. While the decision was clearer when mortgage rates were at record lows, today's landscape requires careful analysis based on one's specific mortgage terms and investment opportunities. Even financial experts are divided on the issue. Research from Morningstar suggests that when expected investment returns are close to a mortgage rate, personal preference should dictate the decision. Investopedia and Rocket Mortgage argue that investing typically comes out ahead, particularly when contributions are made to tax-advantaged retirement accounts. Warren Buffett himself has repeatedly emphasized that, over the long run, investing in the stock market is likely to outperform nearly any debt payoff strategy. However, financial security should not be overlooked. The peace of mind that comes with owning a home outright carries emotional and psychological value that cannot always be quantified. So, how should an individual make the best choice? The answer depends on multiple factors. If a mortgage rate is below 5%, investing is generally the smarter choice, especially when contributing to retirement accounts. On the other hand, if mortgage rates exceed 6% and an individual is risk-averse, early repayment may provide greater peace of mind. Ultimately, financial decisions should align with personal goals, lifestyle preferences, and risk tolerance. While numbers and logic may favor investing, the comfort of being debt-free has its own invaluable appeal. No single strategy is right for everyone, but an informed approach based on careful analysis of one's financial situation and future aspirations ensures a well-rounded and intelligent decision. What would you do? Pay off your mortgage early or invest? Share your thoughts in the comments below. And if you found this analysis helpful, be sure to like this video and subscribe for more financial insights designed to make your money work for you.